Hello traders. Today we want to discuss how to combine multiple times frame and Elliott wave analysis. How to combine multiple times frame and Elliott wave analysis. All right. We're on a monthly chart of $3 Incorporation. The epic is DLTR, Delta Lima Tango Romeo. This is an American stock listed on the Nasdaq 100. And we are on a monthly chart, all right? And we want to combine multiple time frames and Elliott wave analysis. All right, so talking about multiple times frame, we want to use a different time frame. We do not want to use the monthly chart alone. We don't want to use a single time frame alone. We want to use at least two time frame, two or more time frame, to perform our Elliott wave analysis. All right. So if you have been counting Elliott wave, you have been trading the Elliott wave principle, and you are counting wave only on one time frame, it is an Elliott wave analysis mistakes. All right, you have to use different time frame. All right, because the reason is that when we count 1, 2, 3, 4, 5 waves on one time frame, that motive wave is just a mini trend on a bigger cycle. All right, so therefore, when we count wave, for instance, on the monthly chart, it will be wise to go to the yearly chart to see the bigger picture and to see whether our wave count on the monthly chart is also making sense on the yearly chart. So we are counting wave on a monthly chart. We go to a higher time frame. We also go to a lower time frame. All right. So you need to understand that. So Elliott wave analysis with multiple time frame method is about counting wave on one time frame. That time frame is what I would like to call the center time frame. So because I'm on a monthly chart, I'll go to the higher time frame, and also I may go to the weekly time frame. So you want to check it from the higher time frame and also on the lower time frame to see whether it's adding up. You want to validate your wave count. You want to make sure that your wave count is valid. So think of an Elliott wave analyst that want to forecast the market. He will not just count wave on the monthly chart and go and forecast the market. He will do all sorts of verification, the validation of the wave count to make sure everything is up to date, correct, before he will go out and publish that now this stock will go to XYZ. All right, so it's very important. So as an ordinary Elliott wave practitioner or as an Elliott wave student, you want to learn how to combine multiple time frames with Elliott wave analysis. What I'm doing today is a practical, all right, a combination of a multiple time frame and Elliott wave analysis. So I will do it in front of you, and you will keep your eyes wide open and see what I'm doing here. So we're going to start counting wave from since 1995. All right, 1995. Were you born that time? If not, okay, all right. Welcome to the world. So we're going to start counting wave from 1995 up to today. All right. So today is election day, United States. All right. We'll see who is going to win. So now. So if you look at a chart like this, because if you are using TC2000 or any charting software, you need to be very careful. Sometimes you see like this, it looks like consolidation, isn't it? Sometimes it looks like consolidation. All right, you see this section here? It looks like consolidation. But I'm going to do it a little bit seriously. I'm going to zoom into this section here. See where my cursor is moving? I'm going to zoom into that section, and I'm going to start counting wave. All right? There is something I'm going to use. I'm going to use the reference point. So I will use 2000 because this is a technology stock. We know that in 2000, so I'm going to place a vertical line there. In 2000, we have what we call the tech bubble. Right, this will help me to improve my wave count. That's my first reference point. I'm going to use also 2008 2007, where we have the financial crisis, up to 2008. Here it is. All right, that's it. Those two reference points will help me to improve my. Okay, also one last point is the 2009 when the S&P 500 has started a bullish trend. So I have my reference point on the chart to help me improve my wave count. Now, you see what we were looking at, you see here, all this session that looks like consolidation, I'm going to zoom into it now, and you will see that it's not consolidation as such. You see, this is what we got now. Very, very interesting. I've done a bit of, homework, all right? So, you can see that from 2000, all right, to 2007, there is a kind of consolidation here. Will you agree? Boom, 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 in this section here. This is what we call the horizontal triangle. And usually you see this bounce up. I will talk about this another time, okay? The ABCDE, all right, triangle. That's what we call, okay, the horizontal triangle. This is an linear wave triangle. So we know that the technology sector, we have a correction in 2000, all right? So for this talk, the correction was, an horizontal triangle, blah, 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 blah. And then here, it came out. Can you see it? All right? Can you see? It finally came out. 1, 2, 3, 4, 5. All right? Okay? It came out of the triangle. All right? So with that two reference point, I was able to pinpoint this triangle very fast. So without too much, hold on please, I'm going to zoom into it again. Let's go back, my friend. So we know that the technology sector was bullish, okay, up to 2000, up to the year 2000. So up to this point here, I'll call this the first Elliott wave. All right. I'm on a monthly chart now doing this, but we're going to go to the yearly chart and we'll also go to the weekly chart to check few things. All right. So 1995 up to the beginning of 2000, bullish trend. You see the rising channel, you can see here, it's a bullish trend. And that bullish trend was followed by what? Horizontal triangle, a ABCDE, Elliott wave triangle. And now here we have again a new impulsive wave that came out of that triangle. Boom, 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 up. And followed by, okay, look carefully here. That's the beginning, all the way up here. Let's put a bit of color into it to make it more interesting. Okay, with all your, okay, beautiful screen. You can see it. So, hold on, the first Elliott wave is this one here. To 1995 to 2000, bullish trend. Correction. Horizontal triangle. Now we have a new, okay, impulsive wave up here. Let's color it into orange. Good. Followed by another move down, which almost came to the beginning of it. But I want to give this one a chance because you can see that it got a tail. This is what I'm telling you, that we will talk about this. Sometimes you will see this. It looks like a cancel because if you go to the weekly chart, you see a few candlestick bar coming all the way here. But on the monthly chart, we give it a chance because it got a tail. We stop it here instead of here. But by the way, some Elliott wave practitioners believe that the second wave can come all the way to the beginning of the first wave, but shouldn't go below it. The reason why I do not recommend that is because, my friend, for the bullish trend to continue, if the first wave, which is the signature of the bull, we don't want it to be cancelled. We don't want the second wave to come all the way to the beginning. We want it to stop somewhere at 61.8% or 78% and then go up. We don't want it to come all the way to the beginning. This gives us more confidence that the first buyers are still in the market. All right? Usually, it shouldn't come all the way here. That's my recommendation to traders following our guideline. But this one, I'm going to give it a chance because it looks to me there's a bit of exaggeration here. All right? So there's another move down, which we'll call the second wave, or from here, first wave, second wave. So there was one move, correction, 1, 2. Okay. Looks to me another complex wave is underway. Here it is, followed by, okay, third move up. So this is a new, you see, this is an impulsive wave. 1, 2, 3, 4. All right. 4. But we are still on the monthly chart. We'll go to the yearly chart. And you see that by going to the yearly chart, things will start getting a little bit interesting, as you will see. Because if you stop only on the monthly chart, you start getting confused a bit. You may not know what's going on here. All right. It's red. So, impulsive move, triangle. Now another impulsive move, correction, impulsive move, correction. Now this one also, this is another impulsive move from here all the way up here. Now, this is an impulsive move, but let's see, this is the first part of that impulsive wave, because the impulsive wave can be subdivided into 5, yes or no? So, 1, 2, without violating the Elliott wave principle, okay? 3. Be careful, because you see the tail of this candle, okay? That's the fourth manner wave of that impulse wave. I'm going to post a line there, and you will see soon that if you see that this on a monthly chart, do it like I'm doing here, put a vertical line there. You see the tail of that candle. Am I talking to myself? Zoom into it. The tail of this. Okay, am I here? Yes. The tail, this one here. You see this tail here. Yeah, it's a wave. Okay, it's the fourth wave of this impulse wave. 1, 2, 3, 4, 5. But right now on the monthly chart doesn't make sense. With more experience, you will start noticing this. Because you'll be saying, oh, what is the fourth way? What is the fourth way? It looks to me it's 1, 2, 3. Be aware of the tails, right? Between those tall candlesticks. Because you see volatility and then low volatility went a bit. Here it is. So this is the fourth wave of that impulse wave, which I'm telling you that this is an impulse wave because it has been subdivided into 5. And there is no Elliott wave violation because the third manner wave or this impulse wave is not the shortest wave. The fifth manner wave is the shortest wave, all right? And the fourth wave is not, you see the tail is ending here. It's not overlapping the first wave. So 1, 2, 3, 4, 5. This is another impulse wave, all right? And I'm putting a vertical line here, all right? And what we're going to do, we'll come back to that, okay? Now, after that move up, so I'm just going like a child, drawing my lines. Here it is. We have 1, 2, 3. Which pattern is coming to your mind, okay? When you see that is, which pattern is coming to your mind? A flat correction. All right? It's a flat correction. All right? Which color in orange. 1, 2, 3. What are the internal wave of the flat correction? 1, 2, 3. 1, 2, 3. 1, 2, 3, 4, 5. Yes or no? That's the flat correction right here. So as soon as I see that this, so impulse waves, you see, followed by a correction that is starting with 1, 2, 3. First thing coming to our mind, likely to be a flat correction. And then again, 1, 2, 3. You will see soon, if you switch to the weekly chart, you'll see that it adds up. So the flat correction that is developing now is not yet finished. What is missing? The C part of the flat correction. Because the flat correction is a 3-wave, okay, correction, A, B, C. The first part that we call A is subdivided into 3. The second part that we call B is also subdivided into 3. But the C part of the flat correction is subdivided into what? 5. So 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. Now we are expecting what? So what we are doing now, we're going to forecast what is likely to take place here. So how do we forecast the end of the C part of the flat correction? Now, by the way, this is an expanded flat correction. Some Elliott practitioners call it irregular correction. Irregular correction. So this is an expanded flat correction, because you can see that this impulse wave has ended here, but though the flat correction is starting here, the correction went above the impulse wave. All right, so people will be thinking that this is a multi-wave because we have a new high, but the flat correction will go above an impulsive wave. The expanded flat correction will display a new high, which is this one here. But because of the structure of the way the price went up to form a new high, are you getting it now? If a financial instrument, all right, display a new high, but the last move here, I'm trying to share what we call a market stable data with you. So price going up, okay, display high, low, high. If the price form a new high as it did here, and we investigate the structure of that move that went to display a new high, so this move from here to here, that's the one that went to display a new high. But if the structure is standing at 1, 2, 3, it means that there is no demand, okay, to buy anymore. There is a high chance that the price will go down. So normally, the price structure that will go to display new high should be subdivided into 5, not 3. Here it is here, 1, 2, 3, 4, 5, displaying a new high in comparison to this high. This is a new high in comparison to this one. So because we see a new high, for us, Elliott technician, we look at the structure of the price action that went to display a new high. If it is 3, we say, well, it's not going too far. So if you see that it's 1, 2, 3, you just draw your line. Priority to bullish signal above, priority to bearish signal below, top down trading method. Here it is. All right. So look at this one. So this the price went to display new high after investigating the structure of this move. Which one? From here all the way up here. We have seen that this is an impulse wave because 1, 2, 3, 4, 5 without any Elliott wave violation. So this is good. It's telling us this is a normal, healthy progression to display a new high. But looking at this one here, 1, 2, 3, it just stopped there. It's not a healthy bullish progression. It's coming down. Therefore, look at this 1, 2, 3, 1, 2, 3. Now you are seeing the advantage of Elliott traders. Are you getting it now? But what I'm trying to do, don't rush, all right? Just take it. So you know something, all right? So here we are now. The stock is here. So our expectation is that it should come down 1, 2, 3, 4, 5. Because a flat correction is developing. So there's a high chance that the stock will go up like this first. So where it is now, there's a high chance it will go up first. And then it will come down again, somewhere like this. And then it will bounce up a bit again before coming down, completing the flat correction. So you may say, oh, George, thank you so much. I will now just go and buy or sell like a crazy. Don't do that, okay? Don't do that, okay? All right. So remember our approach. We know something. We are expecting something. We don't rush. We just be patient. So at this stage, because we are expecting it to bounce up, draw your line. And then use the top-down trading method. Take it up a bit. There's a resistance here. See this resistance? Bounce up a bit. And then, if you reach this level, you can manage your trade, secure your gain carefully. Watch it. Okay, don't give away profit. All right. And if you receive a sell signal here, well, game on. Put your line again there. Priority to bear signal below. flexible signal above. Those lines will help you to manage your trade. And in all cases, you are using multiple time frame trading method. Now it start going down. Well, it did below this low. You'll be looking for a sell signal below this low. You rush down to this support level. You know that there's another bounce. And so on until you reach the target. But there are more we can do to forecast where the price is likely to go. Pay attention if you don't know too much about the flat correction. In order to forecast the end of the C, we can use what? Fibonacci. Okay. Fibonacci extension from the A part of the flat correction. So this is 1, 2, 3. That's the A part of the zigzag correction. That's the A part of the flat correction. 1, 2, 3. That's the B part of the flat correction. And then we are expecting now 1, 2, 3, 4, 5. That's the C part of the flat correction. I need to remind trader that every ABC correction, the C part is always 5. Is that making sense? The C part of all ABC correction is subdivided into 5 manual waves. So that will help you a bit, all right, to improve your theory. All right, so whether it's a zigzag, ABC, zigzag, all right, the C part is always 5. All right, but for the zigzag, we know that the A is also subdivided into 5. 1, 2, 3, 4, 5. 1, 2, 3. 1, 2, 3, 4, 5. That's the zigzag. Okay, the flat correction. 1, 2, 3. 1, 2, 3. 1, 2, 3, 4, 5. So either zigzag or flat correction. All right, the C part is always subdivided into 5. So with this talk, how do we forecast the end of the C part of the zigzag? We use Fibonacci extension. We draw it like this. So the extension is below instead of being above. All right, so because the part we're expecting it to go down, we want the extension to be below. So the level that we need to highlight, it has a high chance, my friend. All right, this is why you need to remember. It has a high chance to go to the 138.2% Fibonacci extension level of the A part of the flat correction, even up to 161.8% Fibonacci extension of the A part of the zigzag pattern. So our target for this C part of the zigzag pattern is between $51 and $51.34 and $45.41. But it's not going. Sometime, my friend, remember, I need to say this, very, very important. Though, all right, remember this. This is about practical area wave analysis. Though our expectation is that the price goes up like this, goes down 1, 2, 3, 4, 5 in a non-daily manner like this. Sometime you will see something very strange. So if you see, know exactly what's happening. Sometime the price will just go down in a straight line, boom, down. So instead of going in a non-daily manner, 1, 2, 3, 4, 5. All right. But when you see that, you know that it's all in the pudding. All right. So all this 1, 2, 3, 4, 5 is all in the pudding. If it goes down very fast, 1, 2, 3, 4, 5 into the target zone. Don't expect it. So suppose you have a long candlestick bar all the way here. Don't expect another 1, 2, 3, 4, 5. It's finished. Okay, just mentioning that, okay? So you will come across some situation like this. You may say, George, you didn't do 1, 2, 3, 4, 5. What's going on? Okay? So they target $51 and $45. In normal condition, we will expect a normally move 1, 2, 3, 4, 5 down to this zone. Setting a target for the C part or the zigzag pattern. But now, we on the monthly chart, we have done all this. I'm going to start removing line because I promise you that we're going to go to the yearly chart and also to the weekly chart. First, I will go to the weekly chart. I'm going to remove, okay, I leave this one here for now. I'm going to go to the weekly chart first. You remember what I was saying to you before about this red vertical line? We want to investigate whether this is truly, okay, a move down. So in order to do that, we need to go to the lower time frame. If you can't see it, you need to go to the lower time frame. All right. So here it is. Pay attention to the vertical line. I'm going to change my time frame, and I'm going to go to the weekly time frame. All right. So from the monthly chart, now we are on the weekly chart. You see here, this is my vertical line. You see my line? There's a pullback. But you see this pullback with this tall candle. You see, pullback and tall candle. That's why that candlestick bar on the monthly chart got a tail. But now you see that by going from the monthly chart to the weekly chart, it becomes clear to us, truly, there is a pullback here. Can you see? There is a pullback here. Let's put it back there again, you see. You see, there is. By going to the weekly chart, it's now clear to us that that tail is in fact a wave. All right, so go back again to the monthly chart. You can see that it just, okay, where were we? Right here, this is what we are talking about, this one. We are talking about this one here, this candle here. You see, this candle, it's always just one candle. All right? All right? So when we went to the weekly chart to investigate, all right, using different time frame, now you can see that it's a move down plus one candlestick bar. So the price went down first before going up, forming the long tail. So the closing price is up. But though the closing price is up, the price went down first on the weekly chart before going up. But on the monthly chart, we only see one candlestick with a long tail. So now you understand why I was telling you that, okay, this session here was a wave. All right? So use different time frame, okay, multiple time frame, all right? When you are counting waves to investigate, to make sure that everything is working beautifully. All right. Now I'm going to go to the monthly, to the yearly chart. We want to see whether what's going on here exactly. All right. So now I have all I've done before on the monthly chart. I went through all the waves. Okay. So I saw this triangle was easy to spot. This third area wave was clear for us because it was quite extended. But now on the yearly chart, what is going on here? All right. What is going on for this stock Dollar Tree Incorporation? As we are investigating our area wave analysis on multiple time frames. All right. So on a yearly chart, my friend, it looks to me that this move that I'm calling first wave is an impulse wave. So here, up, followed by the triangle. What we were doing on the monthly chart, there's one wave missing here, which I was okay. So on the monthly chart, this is, we have something like this. You remember? All right. You see, so when we go back to the monthly chart, you see. So this is the first wave, all right? This is the second wave, on the, which is a triangle. But on the yearly chart, it doesn't make sense. But when we went to the monthly chart, it was clear to us that we have that horizontal channel, triangle, all right? The ABCDE triangle, all right? So putting everything together with the help of the monthly chart, weekly chart, and the yearly chart is becoming clear to me that this is the first wave, all right, up to 2000, then a correction from 2000 to 2006, and then we have an impulse wave that has been subdivided into 5. What is it? First wave, you see this candle here? This is what we have to see on the yearly chart. Okay, it's just a candlestick. All right, let's do it again one more time. Put a vertical line there, you see. But if you go to the monthly chart, this is the session I was showing you. Where's my vertical line? Here it is. See this move down. You see this move down. So we have first wave, second wave. On the yearly chart, it's becoming clear to us now, yes or no? So we have first wave, second wave. And we are now in a third area wave. So the third area wave has ended here. Look here, right here. But that third area wave has started here. Okay, in fact here. But it was within the triangle, you see. Started within the triangle, came out. And then we have, okay, attention please traders. Are you getting lost? All right, if you get lost, let me know in the comment section. So first wave, second wave, third wave, fourth wave. And the fifth wave has been subdivided into 5. Well, 1, 2, 3, 4, 5. This is the third area wave of a bigger cycle. But that third area wave of a bigger cycle is subdivided into 5. First wave, second wave, third wave, and the fourth wave. The fifth minor wave of the third wave is subdivided also into 5. 1, 2, 3, 4, 5, without any area wave violation. All right, so are you getting it now? Are you getting it now? Without any area wave violation, because the third wave is not the shortest wave, and there is no overlapping between the fourth wave and the fifth wave. So our fifth wave, our fifth minor wave of the third wave, because all this is the third wave of the bigger cycle. So where is the first wave? First wave. Second wave is a triangle. Third wave, all this up to this point. Now what we are seeing here, the flat correction that we are seeing here is the fourth area wave. All right, you see now? So by going from the monthly chart, weekly chart, and yearly chart, our wave count is making sense. We are now expecting the fourth wave to be completed in the zone. You remember the level 51 and the rest one by using the Fibonacci, okay? All right, in this zone. All right, so the fourth wave is a flat correction. 1, 2, 3, 1, 2, 3. We are now expecting 1, 2, 3, 4, 5, or boom, down all the way here, before we will see the fifth area wave for this dollar tree. So what I'm doing here, the reason why I'm recording this video is to show traders how to use multiple time frame and area wave analysis. All right. So there are a few challenges. As you can see, they know just one tail for a candlestick bar on the monthly chart. If you are just on a monthly chart, it won't make any sense for you. So your wave count will get home. By going to the weekly chart, we investigate, we see that, all right, exactly. It's a pullback there. You see again on the yearly chart, one candlestick bar is that pullback here. This 1, 2, 3, 4, 5, this 1, 2, 3, 4, 5 is also the third area wave of the bigger cycle that we see on the yearly chart. So if you go on the yearly chart now, you see why we have. I want you to see this. I want to move my line a bit. Forgive me, my friend. I need to move them a bit. You see this candlestick bar? The flat correction. This is part of the flat correction. Our third area wave has ended here. But if you look at this chart now, if you look at this chart, touch it please. If you look at this chart like this, all right, if you look at the yearly chart, you think 1, 2, 3. You think that the third area wave has ended here. So you say 1, 2, 3. But no. It's the third area wave is ending here. Now it's a flat correction that is forming here in this section here. This candlestick here is the flat correction. So 1, 2, first wave on the yearly chart, second wave on the yearly chart, third area wave on the yearly chart has been subdivided into 5 minor wave, and the fifth minor wave or the third wave is also subdivided into 5 minor wave. All right. Now we see a flat correction. So all this we can see on the monthly chart that there is a flat correction. But if we were counting the wave on the yearly chart alone, we won't have seen the flat correction. You'll be thinking this is just the third area wave. But now, from the monthly chart to the yearly chart to the weekly chart, it becomes clear to us that now we are in a fourth area wave for this dollar tree stock, and the fifth wave is still underway. Now, this is the advantage of using multiple time frame and area wave analysis. So do not be stuck on one time frame. Things may not be clear to you. You need to go to a lower time frame to see clearly, or you may have to go to the yearly chart or to a higher time frame to balance everything to make sure all your wave count, okay, is all right, adding up. Do you like that word? Adding up. All right. You see now? Okay. So I'm going to go back again because my intention at 2-4 area wave is not to give traders, okay, just say to them, buy, sell, because Elliott always say this. That's not my role. That's not the objective of this channel. This channel, our objective is to teach somebody who wants to master the Elliott wave, how to do it, and what is going on behind the scene. All right? All right, so first wave, second wave is a triangle. That's what we call horizontal triangle. All right? 1, 2, 3, 4, 5. All right? This is clear. This is an impulse wave forming a new higher high. All right? But this from 1, 2, 3 is not an impulse wave. It's a correction. 1, 2, 3, 1, 2, 3. We are expecting now, okay, the fourth wave to end somewhere in this zone. 51, we will say 51, okay, and 47. So, but one more thing, there are many ways we can focus at the end of the. So you see, I was telling you in this zone, isn't it? I was telling you, you will end somewhere in this zone. Yes, on 51 and 47. So, but let's use, for instance, all right, the Elliott wave channeling. Okay, I'm going to go to the yearly chart to use Elliott wave channeling to forecast the end of the fourth wave. So how do we do that? You should know it now, my friend. You should know it. So I'm moving some of my lines, so I pinpoint the top. I may have to go to the monthly chart to pinpoint the top of the third Elliott wave, because we need to connect. How do we forecast the end of the fourth wave? Do you remember? All right, I will do it now. And next time I will do it again. Okay, all right. We join the high. You remember the high of the first wave and the high of the third wave. So this is the high of the third Elliott wave. This is the high of the first wave. We connect it. We draw the first line. Are you getting it? All right. Okay. And then we join the low of the second wave. Now it's becoming a bit tricky for me now. Where we join the low of the second wave. And we want that line. Oops, that's not what I want to do. Okay, that low is somewhere here. And we draw a line that is parallel to the first line. Let's do it properly, my friend. Okay. So that's the low of the second wave. And we draw a line that is parallel to this first line. Is it parallel? Let's see. Yep, it look at like it, okay. So we were expecting our fourth Elliott wave to end somewhere near this zone, you see, that projection, okay, coming down. It's somewhere in this zone, okay. So, as I explained to traders before in that video, when the price dip below this trend line, we will use a market geometry. You see, measure the width of this channel. The price dip below it, we project it in the direction of the price, and we draw another line. Okay, we draw another line that is parallel to our first channel. Okay, okay, that's it. But my projection for the end of the flat correction is near this one, near the median line of the projected channel. So our first channel, using Elliott wave channeling, that's the orange channel, all right, telling us that the fourth wave will end here. But we know that to calculate the end of the C wave of the flat correction, one should use the Fibonacci extension applied to the A part of the flat correction, and we need to highlight the 138.2% and the 161.8% Fibonacci extension level of the A part of the flat correction. That zone is needed at this point here, which is also corresponding to the projection of the orange channel in the direction of the price. So if the price dips below or it will dip below it. Okay, there's a high chart, it will dip below it, and we'll try to retest, okay, the median line of the second channel. All right. Now, I need to remind traders that this video is for educational purposes only. It's neither a solicitation or an offer to buy or sell Dollar Tree Incorporation. The discussion today is about how to combine multiple times frame and area wave analysis. Ladies and gentlemen, we have been talking for 40 minutes. All right. I hope you have learned something for this video also. And we put into use, okay, to improve your area wave analysis. All right. Do not use a single time frame to validate your wave count. Use different time frame. Use a lower time frame. Use a higher time frame. Okay. Compare, okay, the price structure on various time frame to the time frame you are counting your wave. All right. We are the TSTWSYS008 traders talking about how to combine multiple times frame and area wave analysis. We wish you the very best in your trading, and until the next time, enjoy yourself and be very happy. Happy trading to you all, and speak to you soon.